Okay, let me start the introduction as people trickle in. So today we're very happy to have another webinar of the 21st Century China Center. As many of you know, I'm Victor Shi, Home Alum Chair in China and Pacific Relations and Associate Professor here at the School of Global Policy and Strategy at UCSD. Thank you for joining our discussion today. The webinar is recorded and will be available on our website, china.ucsd.edu. Please use the Q&A function on the bottom of your screen to submit your questions. I will be reading the questions you submit for our speakers during the Q&A time at the end of the presentation. Today, we're very delighted to have Professor John Yasuda with us. Professor Yasuda is Assistant Professor of Political Science at Johns Hopkins University, specializing in regulatory governance, bureaucratic politics, and comparative political economy. He is the author of On Feeding the Masses, An Anatomy of Regulatory Failure in China, and currently is working on a second book, which he's going to talk about with us today, entitled Necessary Fictions, the State, Stock Markets, and Growth in East Asia, which explores the politics of financialization in China, Japan, Korea, and Taiwan. He received his PhD in political science from the University of California, Berkeley, previously taught at the Hamilton Lugar School of Global and International Studies at Indiana University. He is also a research associate at the UPenn Center for Study of Contemporary China. So we couldn't have timed this better if we tried. In fact, we called our buddies in the CSRC ahead of time and asked them, when are you going to spread the news that the VIE structure is going to be canceled? And they told us the exact date, and so we timed it just like this. No, I'm kidding, of course, but this is a very good time to have John here to talk about security. So with that in mind, I'm happy to hand things over to John. Go ahead.
Great. I'm going to just share the screen here. Wonderful. So we're all set? Great. So thanks again for that very kind introduction. I'm really delighted to be sharing parts of my second book, exploring the sort of necessary fictions undergirding stock market regulation in East Asia, particularly in China. Now, the term necessary fictions refers to the assumptions that regulators adopt about the market as if they were true during moments of uncertainty. And these fictions sort of help link regulatory actions into a coherent vision for market development, establish norms for financial activities, and offer explanations for crises. And so in effect, they make the business of regulation possible. And today, I'll focus on one of these key assumptions that are taken as fact, the who of regulation, the target of regulation, which is who is the modal investor that the CSRC sees itself regulating. Now, the genesis of the project had sort of gone well before, but I was helped along by the most recent sort of debacle in the stock market, which was when the Ant Group, which was basically slated to be one of China's largest, not China's largest, but the world's largest IPO at $34 billion US. And it was unexpectedly suspended following after sort of the individual, pictured here, Jack Ma, the maverick chairman of the Alibaba Group, basically castigated the CSRC, the China Securities Regulatory Commission, in a major conference. And most people, saw this as sort of the CSRC's overreaction to Jack Ma's sort of critique of the management of the financial sector. And the politics have become much more obvious over time. But either way, no matter how you look at it, it was a huge embarrassment for the financial system and the Shanghai Stock Exchange in particular. But moving away, it's not the Jack Ma sort of Ant Group debacle is sort of it's part of a long string of China's schizophrenic approach to its markets, right? On the one hand, China has sought to actively make Shanghai an international financial center. The regulators have been opening up the country to foreign finance through its qualified foreign institutional investor scheme called QFII. They've created the Hong Kong Shanghai Direct Connect, which links the Hong Kong and Shanghai bourses together, and engage in a host of other joint venture projects. In 2013, you'll remember the Shanghai Pilot Free Trade Zone, which wanted to conduct major experiments in yuan convertibility, but also to enable joint ventures in the financial sector. And then following the onset of the COVID crisis, so leading US financial institutions, began to set up shop in Shanghai because they were enticed by a bunch of new measures that allowed them a freer hand in the securities business, the onshore securities business. And the other big change has been that Chinese regulators, as of 2019, 2020, really have made commitments to move towards a registration-based system, a disclosure-based system that's modeled on the United States. I'll go on a lot about this later on in the presentation as to what their version of a registration system is. But so you get this picture of this market that is liberalizing, that's converging on our expectations for what a proper stock market is supposed to look like. But at the same time, China adopts a very hard paternalistic approach to its markets. Now, a hard paternalistic approach refers to regulation that severely constrains investor choice ex ante, usually by outright bans, and also reduces the cost of bad decisions ex post. Now, this is different from a soft paternalist regulatory system, which we associate with liberal market economies, which still essentially respects the autonomy of decision making, not reducing the choice set of market participants, but really just nudges actors towards better decisions through the provision of information and how options are presented to them. So this is, Sunstein and Thaler's sort of nudging work that they've done. Now, it's important to say that while hard paternalism does speak to some risk aversion on the part of the state, it does not mean that the state does not also seek to ramp up investor interest in the market as well, which China has done on multiple occasions through official statements in the press. But the key issue about a hard paternalistic approach is that the state basically says that it will supplant investor logic for its own, right? And so, needless to say, reactions by commentators and global finance have generally been scathing, with frequent interventions in the market described as warping the market, as one FT commentator said. Bans on shorting that happen frequently in China are argued to prevent fund managers with a very useful hedging tool against inflated markets. And of course, frequent rule changes have led another Bloomberg commentator to assert that the stock market regulation is an arbitrary system where the rules can and do change overnight. This is not necessarily the sort of press that you want. And so it leads to this puzzle, which is, why do regulators employ hard paternalistic tools that seem to undermine their efforts to build better stock markets? China's, as you can see here, volatility is a huge problem in the stock market. It has high levels of fraud. And in general, we also see, very a very mixed track record for listed companies. They might do well for a year and then they plummet a year after. And so the general view has been that something's not quite right in the system. And so why do regulators continue to employ the same tools over and over again? And so the argument that I make is that China's hard paternalist approach can be explained by a regulatory fiction centered on an irrational investor that really has shaped, the market's development. Now, there are, of course, a host of important other sort of alternative explanations here. But the argument that I make is that they really only can partly explain what's going on in terms of this persistence of this hard paternalist approach. The classic argument, relies on a lot of theories on how fleet-footed capital can lead to the adoption of a more investor-friendly regulations. And so the argument would be that given China's closed capital account, no wonder you get these hard paternalistic practices. But of course, it doesn't fit that correctly. I mean, if you look at the Peterson Institute, right, that basically sort of foreign holdings of Chinese equities have been on the increase, right? And QFII has also been expanded, but these hard paternalistic approaches still remain relatively unchanged, and I'll show you shortly. The other argument is that it's ultimately about politics and the state's desire to control rents through the financial system. And of course, Victor has shown how access to capital is granted on the base of factional struggles, and others like Meg Ridmeyer have pointed to China's mafia business-like arrangements that use the stock market to create dependence on the state. Again, this is helpful, but it doesn't take us all the way because we know that it is always China's largest financial firms that bear the brunt of these state interventions in the stock market, especially when they're called to purchase devalued shares or compensate investors for losses. And all of these restrictions on market movements, trading practices, and financial innovation have in fact limited firms to hedge their risk during downturns and capitalize gains during the bull runs. So another set of explanations that are helpful as well, but don't take us all the way, suggests that this is really tied to legacies of industrial policy or the strategic value of sectors. But again, there's sort of this inconvenient sort of reality for that narrative because one of the big goals is for China to develop these new innovation stock markets like NASDAQ, and they've been trying to do that for 2 decades. But they've all been pretty unsuccessful, with the regulator still maintaining a really heavy hand, which has led most of China's innovative companies to list offshore. So the state's attachment to paternalism seems more an obstruction to improving the state's institutional comparative advantage rather than help it. So, I basically think that, I've turned to sort of the ideational foundations to help fill in the gaps. And so, as mentioned before, adopting this framework of a regulatory fiction, helps regulators to navigate crises, interpret environments, and reduce uncertainty. And so, I turned to one of these fictions that really came up during a host of interviews and during archival work on, the idealized financial subject that's envisioned by the state. And that's one of an irrational investor. So to start this inquiry, it's actually rather challenging because for those of you who are familiar with financial regulation, it really draws from the Anglosphere. And in the Anglosphere, we assume a rational investor as a financial regulatory subject. And I need to make clear, right, why is this a regulatory fiction, is that our securities regulation is built here in the US on the behavior of a hypothetical rational investor. That is or a reasonable investor. And regardless of all the empirical work that shows otherwise, as a matter of law, right, investors are viewed to be rational, passive, with a long-term horizon and above average sophistication. And cases of fraud here in the United States are benchmarked against the behavior of this hypothetical individual. And it's a source of serious academic debate among legal scholars, because on the basis of this assumption, you build out a regulatory system that envisions a more arm's length relationship to the market to preserve the price clearing mechanism as set by market participants. We operate a mandated information disclosure system to allow these rational investors to make the optimal resource allocation based on their liquidity needs and their tolerance of risk. Now, the regulator polices this disclosure system alongside a host of self-regulatory organizations, the stock exchanges being an important part of that, who set codes of conduct for their practitioners and develop new rules as the market demands. So the move here is then, what happens if you start the sort of building of a regulatory system by flipping that idea on its head? What if you start with an irrational investor and you see that a very different logic obtains, right? The state then takes on the brunt of the risk because it sees its investors as fundamentally incapable of making the right decision. So there are state controls on listing, trading, and product innovation. It retains strong controls over the stock exchange and deploys a system of administrative guidance to allow for maximum flexibility to intervene as problems emerge. Now, in practice, there is a blurring of the lines here in terms of the rationality assumption, because of course, here in the United States, with a lot of the consumer financial protection regulations that are on the books, we've sort of relaxed that assumption, but it's still very much anchored by this sort of reasonable investor fiction. And you can see that China is much more anchored in the other direction. The EU has a more moderate version of investor rationality. Korea and Taiwan closer to the Chinese side. Japan would kind of be the EU kind of equivalent, closer to the blurring of the lines. But either way, no matter what, the sort of initial regulatory fiction sort of anchors the system. So it sets sort of boundaries for how far you can go in terms of reforming your system. Now, this is a qualitative project. It's derived from a host of elite level interviews. And, these interviews were, I'll be perfectly honest, my father was in in the financial business in Hong Kong throughout the 80s and the 20s. And so I managed to connect to a lot of these regulators and senior sort of ex-regulators and exchange officials through those contacts. So discussions of bias here are definitely warranted. And I also conducted a great deal of archival research, just going through this excellent Hong Kong stock market project that's housed at Hong Kong University, that basically is a great archive of materials covering China and Hong Kong, and then looking at sort of various other documents that I've collected along the ways. You'll notice that the field work incorporates Japan, Korea, and Taiwan as well. Hong Kong's there as well, but Hong Kong's part of China. But the idea being here that what I've increasingly found was that there is a great deal of dialogue, and much of what we see in China is actually, comes from Taiwan via Japan and Korea. So let's just sort of dive right into it. So the primary explanation for the regulatory approach as given by CSRC regulators is, it was very clearly driven by this notion of investor irrationality. As one regulator argued, the investor base in China just chases trends, lacks maturity, and they're too impulsive. And because they drive nearly 80% of market turnover, crashes can come very quickly. They're described as chasing volatility rather than engaging in value or growth investing. So they're not really looking at the fundamentals of companies. They have notoriously short investment horizons to the tune of about 2 months compared to about a year plus here in the States. This actually transfers over to institutional investors as well. So, the retail investor profile is problematic, but the institutional investor profile is also problematic. And there's, generally very low levels of financial literacy. And, the regulators, here's just some snippets, right? They constantly bemoan the fact that their investor base isn't mature, that they don't really have great institutional investors. For those of you who follow sort of the institutional investor, retail investor breakdown, institutional investors are playing a much greater role over the last sort of 2 years, but really still 80% of the market turnover. The turnover is still driven by retail investors. And, another official, right, just pointing again to the fact that no one really reads a prospectus in China, that, 2015, they said, look, the corporate earnings were down, earnings per shares were down, but you still have a bull market. It's really irrational here. And basically, so because of this irrational behavior, they say, look, we have to adopt this sort of stringent regulation. And, this was conveyed to me really most clearly when they told me about this Obama and Trump effect in the market. Now, you'd think that this was tied to some macroeconomic concerns built on the US-China relationship, but it's really not. So, right, in 2008, after Obama won, all companies that sounded like Obama's transliterated name, they didn't necessarily have anything to do with America, right? Obama's name and transliterated as Obama. They had significant gains in the market. The two of which, one of was this one called Alkema. So Alkema sounds like Alabama, which is a major cold storage group. Their market price shot up. And another one called Alma Dianqi, so Alma sounds like Alabama, also shot up. And then you see the same thing when Trump wins in 2016. Any company with the character Tuan basically went up to the tune of 1 to 5%, right? Because Trump's transliterated name is Tuanpu, right? So these are the sort of stories that circulate among the CSRC regulators, sort of reinforcing this view of their irrational investor base. Now, so they employ a whole series of hard paternalist tools. Famously, they have for listings management, for the main boards in Shanghai and Shenzhen, they still use a merit-based review system. Where it's an approvals process where they look not just into the company's financials, but they make all these macroeconomic considerations as well. There is a registration trial that's going on, that's being rolled out. I will get to that. You have price limits on the main board. Prices for stocks can't move beyond 10%. Upwards or downwards, and then on the new fancy tech boards, this has been expanded to 20%. There's a T+1 rule, which means you can't really, buy and sell stock on the same day. You have indefinite bans on shorting. You have sectoral bans. So from 2015 to 2018, right after the Shanghai stock market rout, real estate, you just couldn't list. And they periodically have listing moratoriums given sort of when the investment climate is seen to get a bit soft. In terms of financial innovation, you have the positive list system, right? So Of course, there are a lot of wealth management products and various products that emerge, but because the government doesn't specifically allow it, it then enters into this very nebulous terrain. And then everyone, I'm sure, has heard of the national team, right? That goes in to shore up the markets when it's basically when investors are getting too jittery and they want to restore confidence. Now, all of these, right, basically are used to supplant the judgment of market participants for that of the regulator, and they severely constrain market participant choice. Now, the hard paternalist approach is reinforced by a state-oriented stock exchange, right? And in the US or the UK and other localities, you have sort of self-regulatory organizations, but this is not the case, right? And stock exchanges are basically viewed as extensions of the regulatory apparatus. The CRC appoints the head of the exchanges, and they always are drawn from the CSRC's regulatory regs rather than the managerial staff of the exchange. And so there's extreme control over the listings process because they receive clear signals from the CSRC about the suitability of candidates, pricing, and investor breakdown. If the regulator approves a firm, the exchange has to let the firm list. One senior equities lawyer said, basically, the CSRC approves and the exchange handles the procedures. The CRC has to move first. As such, the exchange really isn't supposed to adopt a business mindset. It's sort of thought of as a public utility, and the exchange is really to prioritize listings in accordance with what the regulator deems to be sort of social responsible investment. A good example of this, for example, was during the recent poverty alleviation campaign, for Xi to basically, alleviate extreme poverty throughout the country, which, just was declared a success. But, one of the big priorities then of the exchange was then to list companies that came from designated national impoverished counties, 国家贫困县, right? And so the regulator really doesn't want the stock exchange to engage in new lines of business. So things like high frequency trading, folks, it's way off in the future. And so sort of compounding this, right, is that regulators sort of deploy a system of administrative guidance to police their stock markets, which again sort of further constrains the choice of market participants. It's a web of rules, regulations, and conventions that are flexibly deployed as market conditions evolve. And the CSRC uses a host of these internal guiding documents that are always quite broad and less rigid than the actual statute to guide decision making. Nico Houston at Michigan has a really nice paper on insider trading rules and shows basically that this internal document on insider trading is a lot broader and grants the regulator a lot more maneuverability than the actual law. And most financial houses all speak about being taken out to tea, which is the euphemism for informal window guidance. Now, the regulators understand that, this is not the best way to go about things. And they realize that ultimately it is about control. But they say, look, right now we do have a lot of quick fixes and ad hoc rules. And, there was a view that the law just wasn't up to speed. This is different now because they just passed the new securities law this last year. So, but the idea is that, look, they were a developing system. Everybody else might see it as inconsistent, but we need to do what we can because our investor base is so deeply problematic. And of course, this is just hell, right, for a lot of practitioners. And I think what was striking to me, aside from the constant phoning and letter writing, and no CSRC regulator ever puts anything in writing, but this one CITIC senior partner, a major sort of state securities company, basically said, look, when we go to these conferences, these major sort of financial conferences, like the one at Lujiazui, right? They're like, this is not just polite gatherings. Like, this is real work for us. They have to run around. They have to secure one-on-one meetings. They have to find out where the internal meeting has happened and try to get in them, because they always need to sort of figure out what the regulator is thinking. Now, the problem with this sort of research, right, is financial regulation moves really fast in China, right? And so at the end of my field work, there was the talk of the new STAR market, this new NASDAQ market, with a completely different set of rules. And of course, it made me worried because I had already settled on the story of, okay, China has this sort of hard paternalist approach. And the idea was that China was going to roll out this new US style registration system in the tech sector. So basically, they comply with more stringent information disclosure requirements, but basically then listings would be handled by the exchange, and had the whole buyer beware, caveat emptor sort of logic undergirding it. But when I was talking to two architects of the system, they made it pretty clear that there was a huge misunderstanding about the notion of registration, and that the regulator would still in practice vet companies. After all, one regulator asked, can a process of asking for more information really address the fraud and manipulation in the market and protect retail investors? He continued, this isn't like applying for a marriage license. We still are going to ask the questions. And other practitioners explained that the new board challenged very deeply held convictions about the stock market. So things were not likely to change as drastically as people were thinking. But initially, the board did operate as planned, and there were a huge amount of successful listings, lots of volatility. But by the late 2020s, IPOs more or less have come to a standstill on the STAR market. And regulators are questioning these listing candidates, whether they now have viable business operations. This is a complete move away from what they were trying to do. And anybody who's followed the same process in the KaiNex board, on the Xinsamban, the NEEC board, this is the same thing. And so as of August, 40 IPOs have already been suspended indefinitely. So at this point, though, you might think to yourself, well, why do you keep on banging on about a fiction? This is not a fiction, because irrational investors are the base of China's, they are this modal investor, right? But it's a bit more complicated than that, right? Because are the investors irrational because they are fundamentally irrational, or because the state forces them to behave irrationally? And this was explained to me by a senior government think tank researcher, and highlighted that a lot of the regulators do know that they put themselves into a very challenging spot. And the fact is that China's investors could be seen as behaving rationally, given the uncertainty of the regulatory system. And it goes like this, right? The CSRC basically changes a rule because they see some problems in the market. Investors basically shorten their investment horizon because they don't want to be holding on to stocks too long, which then leads to increased volatility. The regulator then sees this, and it's a confirmation bias, and they say, well, see, we were right. They are, in fact, irrational. And so then they change the rules again, right? And so in many ways, the regulator could be seen as the author of the very problems they seek to solve. So, I'll finish up here. The idea here is that, when you look at this is a pretty different response to the sort of overwhelming sort of torrent of, financialization that's all the rage in the political economy literature that says, look, we're the sort of Anglo-American vision of, financing is the way we're going. China doesn't really comport with this. and that in fact China is much more similar to Japan, Korea, Taiwan. Hong Kong is weird in the region. We can get into that, but the idea is that there's a distinctive regulatory logic, and it really just points to the fact that we have to really get to the first principles of regulatory design, that the choices that regulators make sort of have an anchoring effect on how the system develops, and undoing it is quite challenging. So all of this is to say, I wouldn't really be putting your money into the Chinese stock market for now, at least. Thank you.
Oh, thank you so much. But at a time when a Dogecoin and Inu, I can't even pronounce it. Stocks.
I know. I mean, there's a lot of the talk now where it's like, the retail investors in the US are starting to look a lot more Chinese. And it's really, there's just too much cash sloshing around in our markets right now. So
Right. So we have Q&A again. For those in the audience, I'm sure you have questions. Please use the Q&A function. I'm going to start with a question of my own. Of course, where we have to talk about VIE. What do you make of the announcement of potential abolishing the VIE structure, and then the retraction that we saw soon after that? My sense is that there had been this discussion on abolishing the VIE for quite a long time, a couple of years, and I'm aware of why the timing, why the retraction. What do you make of the whole thing?
Right, but I think you're right. We have to take a much sort of long-term view over this, right? Because the repatriation of China's most innovative firms back to the onshore markets has been a very long-standing wish of the CSRC, right? It's always been slightly embarrassing to them, but there was a reality because the markets weren't as deep, there was too much volatility, pricing was problematic, but they tried this with more gentle forms, with the China depository receipts scheme, which just it went nowhere, right? And so the VIE just sort of comes at a time where you have the confluence of this turn against big tech, right? The US-China trade war. And so, right, this is just the harder edge. So they tried the softer come back to the CDR scheme through the star market, this restarting the new Beijing stock market scheme, right? This is all part of the sort of the carrot that's being offered, but I think the VIE side and really thinking about sort of restricting it as part of the the ban, and I think a ban is coming. I just don't know how this is going to be administered.
Yeah, we talk about potentially the Hong Kong channel. Well, so what you said about the star market is very interesting. Is it my sense? Is it the case that the big innovation of the star market is that a company that wants to list no longer had to show profit, right? So it could be making huge losses, they could still list. But then didn't that just invite a bunch of like truly bad but politically connected companies?
Oh yeah, right.
Onto the queue, and then now they have to jiaoting like this. Everything.
It's there was this belief that they had these really stringent rules, right, for fraud, and so the idea is that rather than just suspending listing, right, if you had any fraudulent disclosure, the idea is that you'd immediately delist, right? So it wouldn't just be this sort of long-term suspension of trading that happens on the main boards, right? And the legal director who was involved of this at the Shanghai Stock Exchange, he basically was like, we know that this is going to be a problem, right? But the whole genesis of the Kechuang ban, right, came due to a speech that Xi Jinping gave during the Shanghai Expo, where and it basically, and rumor has it, but people have basically nodded, saying that it was true that the Shanghai municipal government basically slipped in the line of the Kechuangban into the speech, and the CSRC, which had been dragging its feet on these Nasdaq boards for a long time, was basically caught off guard, right? And again, the whole Beijing stock market story, right, is that there's a speech by Xi Jinping, and all of a sudden we have the Beijing stock market, right? And the realities are that the regulator just it's a complete sort of contrast with how they understand where their market is and the tools that they use to control it, right?
Yeah, no, that's kind of my sense too, that there's this kind of very high level lobbying that's beyond the regulator, like CSRC, and then the regulators. So let's go to a couple of our questions. Guang Lei, who's our executive director here at 21CC, has a very good question, which is that, of course, the regulators may be worried about the irrational individual investors, but or do they actually worry about the hyper-rational, larger institutional investors or even foreign investors whose collective behavior may not add up to some kind of desired outcome at the collective level? And the case, of course, is 2015. So in 2015, you had CITIC Securities doing all kinds of really shady things, like or they actually, I was advising a hedge fund at the time, I have to say, they were offering us the opportunity to short the onshore Chinese equity market right before the big crash in early 2015.
That's so crazy.
So what do you make of these big investors? How worried
No,
are
that's right. I mean, it's linked, right? It is linked. They of course are afraid of these major foreign sort of investment houses, right? And and the CSRC has a very long memory. Like Goldman was involved in all sorts of problematic transactions during the 2015 rout, and in 2019, 4 years later, they were slammed with a whole host of sanctions by the CSRC. But it's like, why is it that so I guess you're right. On the one hand, they're really afraid of sort of the market manipulation that can happen, but it's tied to the fact that you have irrational investors, right? When all of a sudden these big hedge funds, right, start either flooding the market or washing the market with stuff when they want to exit a position, right? The retail investors, they're just chasing momentum anyways, right? So then they follow the trend, and so all you need is just a little movement, and the irrational investors follow on. So it's a two-pronged problem, but they're still tied to this problem of the retail investor. And when I asked them, so I was at the Shanghai Stock Exchange, and I was pretty blunt, and I said, so do you want fewer retail investors, right? And the individuals that I met with, they basically said, no, no, no. This is a socialist stock market, right? The retail investor has a right to participate alongside institutional investors. It's not that we want fewer retail investors, we just want more institutional investors. But when you talk to anybody else, right, like the ex-CSRC officials who are now on the buy side, they're like, no, our position has always been, we have these individual investors that are really, really problematic.
Yeah, and also with social media, they can. I mean, it's just kind of like in the U.S. now, right? So this is why, like, the U.S. is following China with social media. They can act collectively to pump up like a stock like GameStop and et cetera, et cetera. So no, I mean, historically, I do understand this kind of worry, given the experience. And also in the 1990s, there were a couple of spectacular crashes very early on. I think that did kind of traumatize the regulators, the ones who joined the regulators back in the 1990s.
I mean, see, that's the thing, right? And Victor, I think that's like this really interesting point that when I talk to the actual financial practitioners, right, they were kind of like, the CSRC, they just were like, they're like, that it's almost as if they don't want the securities market to succeed. They have this conspiracy, right? Because they said, look, it's kind of like they let us innovate, they let us do what we want, a crash happens, we take all the blame, even though we received a directive from there. Meanwhile, where are we getting all our money from? Right? Because these securities companies don't have that much money, they're getting it from the banks, right? But then why they're always like, but the CBRC isn't cracking down on all these banks. It's the CSRC that's doing this thing. And so there's this whole idea. It's like, do they really want a vibrant securities market, that can really sort of displace or balance out, these large financial intermediaries? And, that's a good open question. It's conspiratorial, but, it was something that, came up frequently.
Yeah, I mean, I think all that interacts, especially now with Xi Jinping's huge obsession with stability, 守住底线, defend the bottom line. So then people in the government just become super paranoid about that. Anyways, the next question from one of our PhD students who's working on tech companies in China, Jeff Hoffman. Yeah, so as we discussed, regulating the firms. Yeah, so maybe you can tell us a little bit about the Beijing stock market, how, what are the requirements for new listings of the firm? And the second question, more kind of tied to his dissertation, is, you mentioned that the annual reports of listed companies is an important source for you. What kinds of information do you get from the annual reports? Is it, and do you think, like, new information that companies put in, like, oh, they now have a Communist Party branch or something like that in the company, relevant information for these listed companies?
Those are all excellent, more technical questions. The basic principle at the Beijing Stock Exchange, right, is that it's the Kehuangban redux, right? It's the star market redux, so no profit requirements and whatnot. But there is this bizarre sort of science evaluation scheme that is also there, and no one knows exactly what that is. Now, this isn't new, right? Like this is exactly what Korea does in KOSDAQ. They have this science technology evaluation scheme that they use as well, and it would not surprise me at all if that was borrowed over. But we'll have to see, right? And it's my general guess again is that there are no IPO pricing caps, right? There was the official sort of 23 PE ratio that they had, but it's those things aren't really there. So it's going to be a lot looser. So these small medium enterprises should have a venue, right? But the problem with small medium enterprises, of course, is that they're small medium enterprises, right? They're inherently risky, and so it's really about the tolerance that the regulator has for these to fail, and for the investors just to eat the losses. Now, there are a bunch of suitability requirements, for who's allowed to participate in the market, right? So I think it's at 500,000 RMB, right? That's the cutoff in order to participate. But everybody knows that it's going to be inherently risky. As to sort of the annual report and the disclosures, what I'm quite interested in, well, I was really interested in to what extent these listed companies were actually doing the business that they said that they were doing. And so my big indicator that I was looking at was exposure to real estate. because right, this is just, it's a good easy measure for like not necessarily fraud, but sort of problems, right? Because it's like this is where you have all these major agricultural companies that were receiving huge subsidies from the government, and they're supposed to be sort of inventing new sort of more industrialized agriculture programs, but then you look and they're just buying property, and developing property. So that was one thing that I looked at. I'm actually very curious. I want a comparative metric for fraud across countries, and I just want to see where China stands relative to other developing countries. But one person that I was talking to who did the analysis just said, yeah, like if you compare China to Russia to Brazil, like China is just way above that. And I haven't really looked at the party organization connection, but that's all of Meg Rithmeyer's work, right? She's done such good work on this stuff.
Yeah, it's always a workers' dormitory, the need to build. It's like, wait a minute, you have like 40 workers and you need to build a workers' dormitory,
Oh yeah, I mean, my dad got pulled in CNOOC because this oil company was just like, why are you buying hotels? It's just disaster, right? So
yes. So China now has a kind of a unique view of its democracy. Do you think Chinese stock regulators also think the Chinese stock market is unique in some sense to fit the needs of China?
yeah, so there are two stories going on. This is tied to, so how do they, like, if the regulator says that there are all these irrational investors, right? They'd be, you'd be like, you're a little crazy to sort of continue down this path, right? Because this is just a losing game for you. Like, how does it improve? And the story that they give is they say, well, look at the United States before institutional investors really took a role. So they constantly are invoking sort of the institutional investor, the rise of institutional investors in the US, which of course is a very distinctive process, right? Tied to, Wells Fargo and all these guys really, taking propositions from Markowitz and all this, that whole group. But either way, that's a vision, right? That, oh no, we're on track. And the more sophisticated vision of version of this was actually by Zhu Rongji's former senior advisor, and he explained, and he was like, look, a lot of stock market regulation in the Anglosphere is driven by it's driven by a sort of middle class ethos regarding risk, right? And so, it's like right now, if you look at households and how their assets, the risk profile is not quite right. And so once, households begin to diversify and whatnot, then, you should see, their appetite for risk coming down, taking more long-term positions, so on and so forth, which is plausible, right? It's a plausible thing, but that really sees China as being much more following a similar trajectory. And they say, look, we've loosened a lot of these paternalistic tools. We've moved from 7.5% movement to 10%. We're increasing the bands of any number of things. So it's not that it's implausible, but then there is this other strand, which is, well, this is also a socialist stock market. The weirdest moment I had was at the Shanghai Stock Exchange, where I just wanted them to kind of talk about the various risks that they were afraid of, not really probing or anything. Like, when I was in the Tokyo Stock Exchange, they were all, their big thing was like, oh, flash crashes. Like, we're just really terrified about flash crashes. And in the Shanghai Stock Exchange, one of these vice directors basically was like, he was like, well, because I said, oh, what are the hidden dangers that you're worried about? The so-called in Huan, right? And he was like, in Huan. Well, he was like, Marx, makes very clear that, capitalism is built on crisis. So this is a natural expectation for a stock market. But because we are a socialist stock market, we have a counter-cyclical process at work. And I said, okay, so there is that still, sort of China unique sort of story going on as well.
Yeah, also like people are trained in different places. You have Gao Xiqing type people who are very Western and they really want a market, like a true market. And then you have this more natively trained bureaucrats, who are more kind of socialist. I'm going to slip in one more question myself, just selfish. That is, do you see the Cyberspace Administration of China as a new CSRC? So if you're a tech company now, you want to list, now you have to go through all these regulatory approvals with CAC, as well as the traditional CSRC approval. Doesn't that make them a de facto stock regulator?
Totally. Yeah, I mean, that's the easy answer, right? So right, so we're in this bizarre world, right? Again, the whole schizophrenic thing where you say you're liberalizing, you want all these newfangled, tech companies to list, to like get capital, to do all this stuff. But then, the response is not to further sort of to loosen regulations, but to create another regulatory system. And it's just the way it is, right? But again, it also points to the real weakness of the CSRC in the structure, right? Because and it's dangerous for them. Like one of the big things that I had talked about, because they were talking about sort of putting all the regulators into the PBOC. And so I just asked them, it's like, oh, is there talk about having a super regulator or whatnot? And all of them were like, oh, this is very sensitive. Like, why are you asking this? And of course, because what they were thinking about was when the CIRC was sort of, all the problems in the insurance market, it gets absorbed by the CBRC. I mean, the CBRC is really good, right? There's a reason Guo Shuqin is there. And so the CSRC is in this funny position, right? And so the poly is viewed as like, well, we need to, have some more oversight over this process.
Yeah, I feel like, and then also, these leading groups are like, saying, oh yeah, we want a new stock exchange and stuff.
Yeah, I know, right? It's back to sort of Sebastian Heilmann's world, right? Where you're going to end up having some sort of financial working group that will go in, bust up the bureaucracy and assert party authority in order to get things done.
Yeah. Well, maybe we can slip in one final question. Has green financing and ESG investing, has that made it into China in a meaningful way?
No, but I mean, I honestly, I don't. This wasn't part of my docket, but the amount of times, because I did ask them, a few regulators. I said, "Oh, are there any explicit regulatory sort of policy goals that you have, right?" And there was a discussion of sustainable finance that was going on, but it wasn't the big thing. The big thing was small medium enterprise, right? And then also sort of the embarrassment factor, right? Like our markets are so volatile, we have all this fraud. But I'm sure there's a lot of good stuff there where it does work. But again, it's like, does the average investor in China, do they care about ESG? And I don't know, you could look at this interesting case with it was Gui Zhentang. It was a Chinese traditional medicine company, and there was sort of animal cruelty involved. And this was all disclosed, right? But a bunch of protesters basically went up against the listing, and the CSRC shut it down. So, it could be changing too.
Well, yeah, we can sit here and talk for hours more. I would love to do that at some point when when things become a bit more normal. Thank you very much again, John. It was a great pleasure talking with you. And for our audience members, we have one more event next week. Jessica Teets will talk to us about civil society as social entrepreneur, strategic rebranding or evolution. As many of you know, Jessica is the premier expert on China's civil society in the United States, at least. So I very much look forward to the talk. Thank you again, John. This is, hopefully we'll catch up in person at some point soon.
I know, I need some stock tips from you, Victor. To see how exposed you are to cryptocurrency. That's my big question for you.
Oh my God, it's a tiny position, but I
you're still in it. Oh, terrible. Okay.
I have some students who are more exposed than me. Let's just say.
Yeah, I know. It's such a bad idea.
These young people, they get pretty nuts, I have to say.
Yeah.
All right, thank you, and have a good weekend.
Great.